everyone. Good evening. You're watching The Money Show on ET now as a part of our Rise with India primetime segment. I'm Mubina Kapasi, and The Money Show is dedicated to helping you make the most of your money, or I suppose as the current market juncture stands, what should you do with your money, your investments if you've made any, and how can you ensure that you as well, or rather your market, your portfolio does not succumb to the selling pressure. But also, even if it does is there really reason for you to panic and pull out all your money? That's essentially what we will be discussing. And of course, not to mention, in our Ask the Money Show segment, we will also give you, our viewers, an opportunity to, as always, call in, email us, take your pick, and you can get your financial related questions and queries answered. Let's talk first about the markets then. Bear territory, that's what we are calling it as, because the Nifty and the Sensex have officially fallen more than 20% from the recent record high. So when a particular market, when a particular asset class falls by more than 20% from the recent highs, we call it bear territory. Certainly very spooky terms, very scary terms, but you know what? This is neither the first and unfortunately nor the last time that we are going to be entering into something called as bear territory. Nifty is only at 9,590. Sensex as well has fallen significantly. Now the question is, for all of you who've been invested in the mutual funds, especially in the last couple of months, especially in the last 1 or 2 odd years as well, obviously you are going to see a big crack in the value of your mutual funds, or what we call as NAVs. Does that mean you have to panic? Does that mean you have to redeem your funds? And even if you have to redeem Yes Bank, you don't want to redeem it over there, right? So whichever way you look at it, there's just a panicky situation all around. So to assuage all those fears, to tell you what to do next, we have Mr. P.V. Subramaniam, CEO of www.subramani.com. Mr. Subramaniam, the minute you entered the studio, the first question I asked you was, have you been busy all day fielding phone calls from clients, fielding phone calls from a lot of investors? Because everyone's wanting to know that, listen, the market has fallen. Should I just pull out all my money?
Yeah. No, actually, funnily, I got more calls saying, Subra, I've got 50 lakhs, where do I invest? So I've got questions on both sides. Okay. Those who panic and those who don't panic, those who are looking at it as an opportunity to buy. So both of them are there, and I've been telling them, just do nothing. It's very difficult to know what's happening, because yesterday also I was telling somebody the fall may not be over, and today I was proved right. The market fell even further. So you do not know whether it's a falling knife, whether the knife has fallen completely and you're just picking it up. So you have to maybe invest 20% of the money that you have, and otherwise just stay calm, but continue your SIPs, don't panic. And if you have a 20-year time frame, if you're young, I mean, even somebody who's like 50 is young because he's going to live till 90 and he's still investing, he just doesn't have to do anything. It's very difficult, you know, just sit tight and do nothing. But that's what you're supposed to do. You're supposed to do your Vipassana, get your meditation right, and just do nothing. It's very difficult, but yeah, that's what you should be doing.
Okay, just be patient. Try to ignore the big screaming headlines sometimes that television channels as well do flash. But, you know, it is our duty to inform, and hence we do, I suppose. But, Mr. Subramaniam, you know, like you mentioned, right, for all those who have a very long-term time horizon, such falls rarely do come. I mean, this is the biggest percentage drop since October 2008. That's since the financial crisis. And, you know, there's this common saying, never waste a good crisis.
Correct.
Don't you think this is one such opportunity? Yeah. And maybe investors should consider maybe increasing their SIPs or anything?
I wouldn't do even that. See, if you see from 2008 to 2012, which perhaps is the biggest class of people who have come into investing, right? 2008 to 2020 means 12 years. So only people who have been there since 2006 and 2007 have seen the 2008 fall. And 2008 had a very, very bad learning for us, that the recovery was very fast. It fell in 2008 and recovered in 2009. I don't think the fall hurts people so much. So people would have by now digested this fall. Now the question is, when does the recovery happen? Will it happen in 2020? Will it happen in 21? Will it happen in 22? We don't know that also. So the question is, if you don't know what is going to happen and if you require money in the next 4 or 5 years, it may not be the best time to be investing more. Maybe you should wait. Maybe you should start buying when you see signs of it going up. Right now there is just panic, and you know, Corona, Yes Bank, all that seem to have happened at the same time, and I don't see any respite. There's a lot of selling happening. There's no buying, so markets can't go up in a hurry. Buying has to happen.
Okay. So at this point of time, basically, the best advice that, according to Mr. Subramaniam, one can give you is do nothing, even though you may be a bit tempted, given the way everybody seems to be in action mode on social media, on everywhere you look, people seem to be in action mode. But I suppose doing nothing as well is a talent of sorts. And I think at this point of time, that's what one needs to do. Okay, I just want to talk to you about an ideal portfolio, the split that one usually has. We often say that gold is like this hedge of sorts. It's a safety component that should be put in. Now, let's assume that, let's say, our investors don't have investing gold. I'm not talking about the gold that's lying, with their wives and the heirloom jewelry. I'm talking about just gold as a financial asset. Let's say if they don't have one, and ideally a healthy portfolio should have a little bit of gold in it. So in such testing times, do you think that they should just simply buy some gold and put it?
Actually, gold has already reacted, right?
Yeah.
See, what happens is by the time we react to what is happening in the market, 100 people, 1,000 people or 10,000 people who are better informed than us have already reacted. So gold has gone up and debt is at an all-time low. If you see the government debt today is at 6.06. This is hardly a time to be locking in your money into a long-term debt. So even if you get into debt, it has to be ultra-short bond fund or liquid fund. From there to buy more equity or equity mutual funds. So I don't think any asset class has been spared. The market has been vicious. So your debt markets have taken a hit with tier 2, tier 1 being written off in Yes Bank, and so all the smaller NBFCs are going to have a problem raising money. So I don't think it's a great place to be in. Debt is not a great place to be in. It's a little too late to be in gold. So no choice but to be in equity, but don't be in a hurry. Or if you have, say, you have a portfolio of 1 crore and you have 10 lakhs to invest 1 lakh, invest 2 lakhs, test the waters, put your toe into the water rather than jump into the water. There's no hurry to invest. Invest slowly. Market is not running away in a hurry. Aram se upar jayega. You'll get enough time.
Any tactical allocation you'd advise in, maybe the shorter term debt, because everywhere we're reading about how bond yields are at, record lows in the US, in India.
Yeah, so therefore a liquid fund or an ultra short bond fund rather than a gilt fund or things like that. Don't lock in there because interest rates have to go up. See, the market is pricing in saying that Corona is end of the world and the oil will be at $30. Both are not true. Corona may not be the end of the world. It may take more people, 3,000 dead, maybe 6,000 will die. We don't know. We have to wait for it to end. I don't think it's going on for too long. Once the summer comes in, I think Corona impact will go down. The oil will go back to maybe $37, $38. So there will be more sense. Yeah, the dollar is getting strong, so some money of yours should be in the US and some money should be in equity, which could be large cap funds and mid cap funds and small cap funds. If you want to add very small, add 20% and then wait for some more fall. Maybe the market will stabilize at 29,000, 30,000, 27,000 of the Sensex. That's the time when you put in more money. Right now, I don't see the market stopping at this position.
Okay, all right. Well, you know what? I want to just remind our viewers, if you have any questions or queries, here's your chance. We're going to kickstart our Ask the Money Show segment. The number is appearing on the top of your screens, 24990300. You can call in. You can email us as well on themoneyshow@etnow.tv. So let's take on board a query that we've received via email. First up, we have Kanan Kumar, who writes in to us saying that I started an SIP of 5,000 rupees in 2017 in the ABSL Banking and Financial Services, that to a direct and a growth plan. Again, ICICI Prudential Banking and Financial Direct Growth Plan. And unfortunately, after 2.5 years, investment cost has exceeded current NAV. Given the banking scenario, do you foresee improvement in the near future? Should I hold /sell /buy to more such mutual funds for the next 2 or 3 years? Okay, so firstly, sectoral, funds, and I know Mr. Subramaniam, you don't feel very strongly for them, even though they do tend to give great decadal returns. Secondly, he's chosen a direct plan, means he was confident of what he was doing. He may have read from wherever. What would you recommend him do? He's saying that, he wants to hold /sell /buy more such MFs.
Yeah. So very clearly he has not given us the full picture. If this is the only thing that he has, I think you should stop one of the SIPs at least, because you cannot put all your money into just 2 sectoral funds. Two different schemes of the same sector. This doesn't make sense. At least 5,000 should be in a large cap or a large and mid cap fund. So this doesn't make sense. So therefore, he should stop one. But if he's got other investments anyway, he's got large cap, mid cap, etc., then he should let this run for the next 10 years. See, when he started in 2017, he must have taken a 10-year view, which means in 2027. So why is he panicking in 2020? You're not supposed to look at it in 2020 at all. You started in 2017, you wanted to put it till 2020 or 25, whatever. You definitely were not looking for a 3-year thing. But yes, it's going to look very bad. It is going to look red for maybe another 6-8 months, 1 year. And then it will revive. So no stopping. But I don't know your full picture. If this is the only thing you have, then at least stop one and shift to some large and mid cap, something like some other fund which is a large and mid cap in the same ABSL. But don't stick to just one banking fund. Just one banking sector, 2 funds makes no sense.
Okay, fair enough. You know what? We'll just have to slip into a very, very short break right here on the Money Show. But don't go anywhere. We'll wait for those calls to accumulate and we'll get them answered after this very short break.